For decades, when we thought about the world's manufacturing powerhouse, one name dominated the conversation, that is China. From smartphones to cars, from steel to semiconductors, China became the undisputed factory of the world, churning out goods at an unprecedented scale. But now something is changing, something big. Look around, and you'll notice a shift, a quiet revolution that's reshaping global supply chains. Major corporations from Apple to Tesla are diversifying their production hubs. Countries that were once considered too small or too risky are now emerging as the next big manufacturing giants. And here's the real shocker. Some of these nations were nowhere near the radar just a decade ago. In this video, we will uncover the real reasons behind this shift, the hidden forces, the economic strategies, and the surprising new players that are quietly taking over the world's factories. This isn't just about business, it's about power, influence, and the future of the global economy. So, which country is rising while others fall? Let's find out. As global manufacturing dynamics shift, one Southeast Asian nation has risen from relative obscurity to become a pivotal player in the global industrial landscape. The country is Vietnam. Vietnam's government has launched the National Digital Transformation Strategy, integrating AI, blockchain, and cloud computing into manufacturing. With this push, FDI surged by approximately $25.35 billion, a 9.4% increase year on year. This initiative aims to integrate technologies into business operations, thereby increasing efficiency and global competitiveness. Complementing digital transformation, Vietnam has refined its investment regulations to attract both local and foreign investors. The revised law on investment, effective from 2025, streamlines business registration procedures, reduces bureaucratic hurdles, and offers incentives for sectors like high-tech manufacturing. These reforms have reinforced Vietnam's reputation as an attractive destination for foreign direct investment in Southeast Asia. Notably, a significant US business delegation, including industry giants like Boeing, Apple, and General Electric, visited Vietnam in March 2025 to explore investment opportunities and strengthen partnerships. This delegation reflects the strong confidence in Vietnam's economy and its strategic importance in global supply chains. The country has become an attractive destination for semiconductor manufacturing, with companies like Hana Micron and Amkor Technology investing heavily in chip packaging and testing facilities. Hana Micron plans to invest approximately $930 million by 2026, while Amkor Technology is investing $1.6 billion in a new advanced packaging plant. These investments are set to increase Vietnam's share in the global chip assembly, testing, and packaging ATP sector from 1% in 2022 to an anticipated 8 to 9% by 2032. The GDP of Vietnam grew by 7.5% in the fourth quarter of 2024, the strongest growth compared to last year. This surge was driven by robust exports, industrial production, and rising foreign investment, highlighting Vietnam's resilience and adaptability in the face of global economic challenges. But while Vietnam is surging ahead, another country far from Asia is quietly emerging as a manufacturing giant, one that shares a border with the world's largest economy. We're talking about Mexico. So, let's break it down. US companies are increasingly shifting their manufacturing operations to Mexico to bring production closer to home, a strategy known as nearshoring. This move aims to minimize supply chain disruptions and lower costs compared to overseas production. If nearshoring fully materializes, Mexico will be a big winner, with manufacturing exports to US buyers expected to exceed $600 billion in 2028, up from about $455 billion now. Consequently, Mexican manufacturing exports to the US could grow from $455 billion today to an estimated $609 billion over the next 5 years, significantly contributing to Mexico's GDP growth. The impact of nearshoring is substantial, with new investments potentially reaching $46 billion over the next 5 years. This influx of capital could help drive Mexico's annual GDP growth to approximately 3%, between 2025 and 2027. The other aspect of Mexico's rise in manufacturing is its favorable trade agreements, particularly the United States-Mexico-Canada Agreement. The USMCA provides Mexican-made products with duty-free access to the US market, making it an attractive alternative to China, which faces increasing trade restrictions. This advantage has not gone unnoticed. Several Chinese manufacturers have already started relocating their operations to Mexico to bypass tariffs and maintain access to the US market. In fact, between 2023 and 2024 alone, Chinese investment in Mexican manufacturing increased by 48%, with electronics, automotive, and machinery industries leading the charge. However, Mexico's rise in manufacturing is not without challenges. Political uncertainty, labor disputes, and concerns about US trade policies continue to be factors that could affect future growth. The rise of Vietnam and Mexico isn't accidental. They are capitalizing on global trade shifts, geopolitical tensions, and changing consumer demands. With China facing rising labor costs, trade restrictions, and economic slowdowns, companies actively seek new manufacturing hubs. These two nations have succeeded because of strategic location, cost-effective labor, and government incentives and trade agreements. The factory of the future isn't confined to one country. It's shifting, evolving, and creating new winners. The question is, who will dominate next? And what does this mean for you? Take a moment to think about where you fit in this global shift. As we wrap up, a few big questions emerge from these shifting global dynamic. Can Vietnam sustain its tech boom? Will Mexico fully capitalize on nearshoring? Drop your thoughts in the comments. And if you found this breakdown insightful, hit the like button, subscribe, and stay tuned for more deep dives into the changing world economy.